We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodjevics. Joining me today is Alasdair Macleod, Head of Research at Goldmoney. How are you today, Alasdair?
I'm very well, Tom. Thank you.
Excellent to have you back on the show and to get your perspective from across the pond here. So, you and I were speaking before we hit record here about the fact that the real inflation has already occurred. And are we just seeing the symptoms of it now?
Yes, we are. And it just amazes me that all these brains in the investment management industry and all the rest of it completely ignore the link between the expansion of the quantity of money that's occurred, particularly over the last 2 years, and what's happening to prices now. I mean, how can they buy the idea that this is just transitory? I mean, it's not. The classical definition of inflation was actually the increase in the quantity of money. What happens to prices is the consequence of the debasement of the currency, which is the result of the expansion of its quantity. I mean, it really is as simple as that. Now, for too long, everybody's just sort of thought inflation is just this sort of thing that arises from excess demand over supply. And, the way to deal with that is to dampen down the demand by raising interest rates a little bit or whatever. I mean, it's a complete load of rubbish. This basically, I mean, the current form of rubbish dates back to Keynes's general theory, where he tried to overturn market economics by denying Say's law and replace it with state economics. And everybody's been enthralled to the state ever since. Big mistake.
So considering that the Fed has recently released its highest CPI print in 30 years, how far apart do you think the CPI number is from true inflation, and how would you prefer to measure it?
Well, true inflation, as I was saying, in the classical definition, and that's the one I stick with, over the last 2 years, looking at M1, has been about 400%. I mean, from 4 trillion to over 16 trillion. That is hyperinflation. I mean, no doubt about it. The question then arises, before I tackle the thing on prices, but the question then arises, is that likely to stop? And I'd say the answer is no. And I would say that the reason it won't stop is that, first of all, you've got a government that's spending money like drunken sailors on shore leave. I mean, you've already passed an infrastructure bill. What was that, 1.2 trillion? There's also another bill in the pipeline for another 1.5. Now, that's on top of previous deficits. I mean, the deficits last year was $3 trillion. And I mean, this year, the Congressional Budget Office, I can't remember exactly what they were forecasting, but they reckoned it was going to come down. No way. 3 trillion is the base from which it's going to increase. So coming back to money supply, how is it financed? It's financed basically through money printing, because you don't have a savings-driven economy in the United States. Somewhere like Japan is different. If they print money, people just tuck it away in their bank account. It's taken by the banks and it's lent to industry. It doesn't appear automatically in consumer spending. But in America, it basically does. And there's a huge overhang of unspent consumer money from a combination of the money printing that, sort of helicopter money and all the rest of it, increased welfare, and at the same time, people being locked down. And that's what's driving, if you like, turning all the excess money into higher prices. 6.2% for an estimate of inflation last month is, first of all, it's only the start of the process. It's going to continue. Month per month, there's no point in looking at a month-per-month figure because you've got numbers dropping out at the other end and all the rest of it. And another reason why there's no point in looking at the CPI is it's a heavily doctored statistic. I mean, I wouldn't say that John Williams' statistic is necessarily correct, but he's coming up with figures that are looking closer to 15% inflation and price inflation, that is. And who do you believe? I mean, the answer is that if you're all part of the establishment and you're a good little regulated fund manager, you believe the CPI. If you're a cynic like me, who's seen all this before, you tend to side with the John Williams of this world. So the answer to your question is that 6.2% last month is only just the start of it, and it's going to get a lot worse. Not necessarily on a per month basis, but certainly looking at it over the next, say, half year, you're going to see inflation far higher. And that means that interest rates will rise. Either they rise or the dollar tanks. So there will come a point where they have to protect the dollar. And in any event, there comes a point where they won't be able to fund the government deficit out of the expansion bank credit without raising interest rates. I mean, I saw, as a stockbroker, I saw all this back in the 1970s in the UK. We had a situation where the government basically had complete control over the Bank of England, tried to tell the Bank of England how to fund itself. It ignored the Bank of England's advice, and it tried to sell gilts, which is government stock, at too low a yield. I mean, a higher yield than last time, but inflation was beginning to run off, and it eventually peaked at 24%, and that's on official figures. So really, what they had to do, the only way they could unlock the logjam, because if a government doesn't fund itself, the inflation figures start going absolutely crazy. So because it's spending money, it just hasn't got. I mean, it's as simple as that. There's no offset, if you like, in terms of savings going into government securities. And the result of that was that they had to jack up the interest rates to extraordinary levels. And I remember there was one stock, which was the 15.25 Treasury in 1998. Now, the coupon gives you an idea as to how high they had to rack up interest rates in order to get that one away. Mm-hmm. I mean, I've seen this before, and I can tell you it's going to happen again, but this time it's not going to stop with a Volcker turning around and saying, right, 20% Fed funds rate, and we'll challenge these guys who are going out of the dollar with a real nominal cost. And it was that turned it around. Can you imagine anyone at the Fed doing that? I mean, I can't see it. And for a start, nobody's got a mandate to do that sort of destructive move.
Yeah, it seems like that political appetite really isn't there. And with the amount of debt that they have to repay, there's no practical way other than just printing the currency into oblivion to maintain that debt at a higher interest rate, right?
Yeah, it happens every time a government begins to rely on the printing press to fund its deficits. They just get bigger and bigger over time. And this is a process that started a long time ago. You go back to the Reagan years, and he was running record deficits then. I'm not going to go into that. I mean, there was a sort of a political subplot in that, but ever since then, I mean, I think with the exception of Clinton, we had deficits just expanding and expanding the whole time. Mm-hmm. It wasn't a problem for the dollar in those days because, the other side of a government deficit, unless you get an improvement in the savings rate, is a trade deficit, a deficit on trade. But the balance of payments is a different thing. The balance of payments only arises if the foreigners, having received your dollars in payment for their goods, start selling the dollars. By and large, they haven't done that. They've accumulated, the last count I looked at, which is about a month ago, around about $33 trillion of financial assets and deposit money in the corresponding banking system. $33 trillion is roughly 1.5 times the US GDP. So your dollar is over-owned by the foreigners. And I can tell you, it won't take much to spook them. We've got the same thing actually here in the UK because, the dynamics are slightly different. We haven't gone to quite the same extent of money printing as the US has, but we've done naked QE. We're still doing naked QE. The governor of the Bank of England is in denial about inflation in exactly the same way as Powell is. We're doing exactly what America is doing, but on a smaller scale. And we have got foreign investors holding sterling. We've also got the added problem here that the credibility of the government, which started off, reasonably strongly, is now deteriorating. And I think it's a short matter of time before the foreigners holding sterling decide that this isn't quite what it was originally cracked up to be, because the Conservative government are not following through on their agenda. I mean, if they follow through on the agenda and, for example, went back towards free markets, set up a chain of free ports, all those things, reduce taxes, cut government spending. They never said cut government spending, but that had to happen anyway. And if they did that, then it would be a very different thing. But as it is, we're sleepwalking into a disaster here. And then if you look at the European Union, the EU, run by the ECB, I mean, that is an extraordinary mess. I mean, it really is. That's just sort of sinking. It's the only way to describe it. The idea that negative interest rates is a stimulus, it's not a stimulus. It just means it's cheap borrowing for the government. And that's basically all the ECB is now interested in. So, if you're a manufacturer in Europe, good luck to you. It's the short answer. Outlook, not good.
Mm-hmm. So I'd like to go back to, a term that you used earlier, Alasdair, and that's hyperinflation. And you just mentioned, confidence. So I want to get your thoughts on, how we actually define hyperinflation. Is it more, a numeric statistic that, once we hit X amount per month or per year of devaluation of currency, if that defines a hyperinflationary environment, or is it more exactly as you mentioned, the lack of confidence or the falling of confidence in the government's currency?
Well, I think the idea of trying to define hyperinflation by attaching a number to it is actually a mistake. What we should be looking at is the current situation and how it is likely to evolve. And as we've already discussed, I think the situation in America is that you are in the early stages of a hyperinflation unless there is a change in monetary policy sufficient to negate the inflation that we've seen so far. I see no sign of that whatsoever. I see, if anything, the government going in the opposite direction. And not only that, but all the signals we get from government is that, when things go even more wrong in the private sector, their answer is to just jump down on the private sector. They're moving away from free markets, which can be the only solution. There is also the broader question of confidence. You mentioned that word a couple of times. And this is where the monetarists actually get the relationship wrong. You can't say that because inflation, let's say M1 increased by 400% over the last 2 years, that's going to give us, a 230% annualized rate of price inflation. You can't do that because the effect of monetary inflation on prices boils down to a combination of the diluting effect of money as it enters into circulation. And that's never an even story. I mean, it's a gradual process. And also any changes in confidence that the money's users have in its purchasing power. And this is what, if you look at an extreme example, if people lose all confidence in the dollar as money, then it will be completely worthless. It doesn't matter what the quantity is. It will just be completely worthless. If, on the other hand, they think that the purchasing power of the dollar is going to go up and up and up and up because of monetary policy, for example, or something that's stated that we want to have a higher dollar and they actually back it with some sort of actions, then what people will do is they will tend to hold on to their dollars in the expectation that there will be lower prices in future. So they defer their purchases instead of bringing them forward. And that, again, will tend to increase the purchasing power of the dollar, irrespective of any changes to its quantity. So you've got to look at both things. And confidence in the purchasing power is extremely important. You can't look at one without looking at the other. And the point about where we're going is that when people finally wake up that it's actually money going down, not prices going up, then at that stage, all hope for the dollar will be lost. Because this is what the Austrian economists call the crack-up boom. It leads into the crack-up boom, which basically is when people take every bit of cash they possibly can get their hands on and spend it before its purchasing power goes down even more. And, the tales from Germany in 1923, when, a chap would go and collect his wages from the bank, and he would do this twice a day, ends up with a barrow load of paper marks, goes into the shop and says, right, I want to buy whatever it is, and goes out to get the money and finds that the money is being dumped and the wheelbarrow stolen. I mean, that is where we will get to unless something is done about this current situation. I see no move to deal with it. And the fact that the authorities are not only ignoring it, but I think indulging in very severe groupthink on the whole thing. So dismissing any alternative explanation of the current situation out of hand tells me that things are going to have to get a lot worse before they begin to wake up to, oh dear, we've got a problem here.
So when we think about the effect of inflating the let's say the national debt away by paying it down using dollars that are worth less than when they were borrowed, how do we get the opposite effect in wealth from the private sector back to the government?
I'm just trying to unpick what you were saying there. I mean, the situation in the past was, really from the 1950s onwards, was that most countries like America, Britain, and so on, managed to reduce the level of their debt to GDP, basically by suppressing interest rates. And being on a sort of quasi-gold standard, there was price stability along with it. So the increase in GDP basically was a large part of the reduction of that ratio between outstanding debt to GDP, and it also allowed them to pay down some of the debt. So that was the situation. Today, we have a completely different situation. We have accelerating inflation, and on my analysis, this inflation is going to accelerate even more. And we've also got a different sort of economy because going back to, again, the 50s, you had, welfare payments. The welfare state was increasing, but not at the rate it's done now. No way. So you have a situation where you've got to keep an eye not only on the, if you like, the diminishing value of current debt, but you've also got to keep an eye on how it's escalating future debt. And I think, I can't remember, there was an economist who came out with a figure, I think at around about the time of the Lehman crisis, who reckoned that the net present value of the US's future welfare liabilities was in the order of $212 trillion. These are huge figures. Now, you can make that figure almost what you want, depending how much you discount it to a net present value. But the point behind it is absolutely right. And that is huge debts down the road. And they are made even more massive by monetary inflation, by reducing the purchasing power of the currency, because the debts are real. That's the important point. And these are not just debts which are, say, pensions and things like that, which the government can sit on. It can sit on by, for example, fixing the rate at which the CPI reflects inflation. If you can depress the level at which inflation has been reflected in the CPI, then welfare payments to state pensions, unemployment, and so on and so forth can be sat upon. that's not a problem. But your problem is the other costs, like if you're providing a national health service of some sort. That in particular, you find that the costs will really reflect what's going on in the real world. And that is why the net present value of your future welfare liabilities are now getting completely out of control.
Mm-hmm. So, you've mentioned several times, Keynes being the start of this monetary experiment. But of course, we've seen the failure of many fiat currencies or all fiat currencies throughout history. So you recently tweeted or retweeted one of Paul Krugman's tweets saying that he got inflation wrong and that he didn't see this current surge coming. So why do you think that is, Alasdair?
Well, he's a Keynesian. I mean, he's not an economist, actually. I mean, okay, he won a Nobel Prize for being an economist, but that doesn't make him an economist. It's rather like Hayek, who was a great friend of Keynes, though they sat on completely opposite sides of the debate. He said, Keynes isn't an economist, he's a mathematician, and pure and simple. And I would say, I mean, I don't know the extent of Paul Krugman's maths, but he's certainly not an economist. And so in that sense, it's not surprising that he got inflation wrong. I would describe him more as an apologist for the state as opposed to free markets. He's an apologist for socialism. And when you put those things together, the last thing you want is reality. The reality of the situation. So it's a bit difficult for someone like Krugman to actually look at, the story of inflation. I mean, if I can just digress slightly, Joseph Stiglitz, some time ago, same sort of guy as Krugman, endorsed Chavez's monetary policy. I mean, I'm going back to when Chavez was alive. In Venezuela, he reckoned that the best way to stimulate the economy was to increase the quantity of money. And look where it got them. I mean, it's just completely destroyed now. And now, okay, I mean, it's not entirely under Chavez, it's now under Maduro. But, I mean, there's been no change in the monetary policy, that is for sure. And they've just completely destroyed the currency and the economy.
So, of course, there's, another piece of the price inflation that we're seeing that can be pushed back upon right now. And that's the breakdown of all the supply chains, Alasdair. And, again, you and I were speaking before the interview here about, let's say, the reality versus the perception in the UK that we see of rising gas prices or gas shortages, things like that. So how do you actually see that affecting yourself versus the news stories that we read about it over here?
Well, there's several parts to that question. I think I'll start with energy. I think that's probably a good place to start with. When you look what's been going on in terms of energy supplies, I mean, undoubtedly there is a story over gas, yes, and it involves geopolitics. It involves a Russian pipeline going into Germany. It involves the Ukraine. I mean, we've got all these sort of stories basically going on. But what it amounts to is that the amount of gas being supplied to Europe is being restricted. We've also, in the pursuit of this sort of climate change thing, decided to shut down, decommission coal-fired stations, gas electricity stations. So now we have unreliable energy, like it's wind and solar, which requires the right weather conditions to maximize the output. We're turning demand on its head by telling everybody they've got to go and buy electric cars, and we're going to do away with, sort of motor vehicles completely by, I can't remember when it is, 2030, 2035, whenever it is. Now, bear in mind that something like 98% of logistics, onshore logistics, and offshore for that matter, is diesel driven. That's all got to stop. So you can see that, we've really screwed ourselves by a mixture of trying to do away with demand for fossil fuels and therefore restricting the supply of electricity through those, and while increasing the demand for them on the other side. Mm-hmm. So the whole of the fossil fuel complex is rising in price. And when I look at the West Texas Intermediate price, which is currently about $80, I wouldn't be surprised to see that at over $100 by Christmas. And Christmas is 5-6 weeks away. So, that could be a rather nasty surprise for anyone. We're finding that petrol prices, or as you call it, gas prices, are also rising. And I know they're rising in America towards record levels. And then, of course, on top of that, you've got the supply chain problems. I mean, I live about 3 miles from the sea, and I go down to the sea and I walk my dog and I look out and I see container ships at anchor. They can't get into a port. The problems off the Californian coast are bizarre. I mean, they really are. I mean, there's something I think, either out at anchor or steaming around, waiting to find an anchor spot. You've got over 100 container ships. It's just amazing. And we've still got other problems. And of course, all this is really on the back of a fashion that developed from the 1980s onwards. And that was just-in-time stock management, which basically means that nobody's got any inventory. And you rely on efficient logistics to get stuff delivered just in time. That chain is just completely broken. So we've got a major disruption. Now, on top of that, if you look at the amount of money deposited by consumers in your banking system, it's gone through the roof. I mean, it really has. And this is effectively unspent money. Now, if I was an American citizen sitting there with my bank balance higher than I would normally feel comfortable with, and not because I'm worried about the bank, but, I just have a spending habit. I will put aside a little bit, but not more than I really need to. I think, I'm not being rude to Americans, but I think I'm describing the situation reasonably. Now, sitting on all that cash, what am I going to do with it, for goodness sake? I got to go out and spend it somewhere, and I will spend it. And that is what's going to drive prices higher up and between now and Christmas and beyond. And we've got the same problem here, Tom, exactly the same problem. So I see no end to this, the combined disruption, if you like, of higher energy prices. It affects all sorts of things you'd never dream of. I mean, the production of carbon dioxide was also affected by it, because the energy costs of processing waste from which this is derived, make it completely uneconomic. So we had, I think it was about 2 months ago, we had supplies of carbon dioxide, which are all in the hands of an American company operating over here. I'm not saying that's wrong or right, but they completely understandably took the view it was completely uneconomic to do this. So they just shut the plant down. The result was there was no carbon dioxide for our fizzy drinks and for health purposes and all the rest of it. So, I mean, it's all these little things, that sort of happen at a time of monetary disruption. And I tell you that when you see these little things going on, and you see maybe food shortages beginning to develop, look at for example, Holland do a lot of intensive vegetable production. And this relies on greenhouses, sort of with shelves stacking up, 20, 30 feet. And it's all driven by energy. It needs electric power in order to keep the thing going. So what's happening is driven up the prices of these things. And it's just completely uneconomic for that industry to produce vegetables. So, everywhere you look, it is a problem. But the common root behind it is the unfettered production of money for us to pay all these higher prices.
That's a great point, Alasdair. And you mentioned something in there about monetary disruption, and of course we've seen the rise of cryptocurrencies like Bitcoin and Ethereum, even some of the smaller ones that began as a joke. But I've heard you speak before about a scenario that we could see a backwash from cryptocurrencies into the metals. So could you tell us about how that could happen?
Yeah, it's an interesting one. I'm theorizing a little bit, but what I've seen so far is that the investment community, and by that I really mean the hedge funds, the investment managers who have a choice, if you like. If they begin to understand that there is an inflation problem, they either go and buy some gold or something that relates to gold, or alternatively now, they can buy Bitcoin. If not Bitcoin itself, they can deal in regulated equivalents like futures and so on and so forth, which obviously has a knock-on effect in terms of demand for Bitcoin. Mm-hmm. So far, and I can understand this, every investment manager worth his salt is going to go where he thinks the performance is. So, when you see Bitcoin sort of move up from $40 to $70, that's where you go, isn't it? You don't mess around with gold, which has gone absolutely nowhere. So the result is that the hotter side of investment money is all in cryptocurrencies. It is not at all in gold and silver. So that, if you like, is an imbalance. And I think it's an important imbalance to understand, because the idea that Bitcoin is a hedge against money printing can only go so far. Bitcoin enthusiasts will claim that it is the replacement money for currencies. Once currency fails, then it's going to be, people are going to select distributed ledger cryptocurrencies like Bitcoin or Ethereum or whatever to do their transactions with. That is pie in the sky. It really is. You can begin to think that way if you move in circles which are entirely millennial geeks, who are sort of so sold on what they're doing, and they don't actually understand the wider world. But the wider world actually requires money it can trust. And that is not something that they don't understand on their mobile phone or whatever. It's going to be gold or silver, and most likely both. Now, there will come a point where people begin to understand this, that actually you've got to shift your strategy from hedging against excessive production of paper currencies to moving your investment into the most likely next money. Then you're taking a very different decision. And I think it's at that point that you will find there's a huge backwash out of cryptocurrencies into gold and silver. It's really quite simple. I don't know when it'll occur, but I do firmly believe it will occur. And I'd also add, cryptocurrency has been a wonderful ride for anyone who's got in there and enjoyed it so far. And I have no doubt that the Bitcoins of this world can go quite a lot higher. But the level of enthusiasm for something that has no intrinsic value is essentially a bubble. I understand there are now 6,800 or over 6,800 cryptocurrencies in existence. That was looking at, that was just Googling it. And, there's only 180 paper currencies, sort of fiat currencies in existence. So you can see that gives you a sort of rough idea of the amount of speculation that is in that cryptocurrency space. Mm-hmm. And there's no doubt that this is behind the current move by central banks to produce their own cryptocurrency, central bank digital currencies. But I don't know of any central bank. I haven't seen anything in the committee which is being run by the Bank of International Settlements that suggests that this is anything but another means of expanding money and credit into the economy. In other words, that's just going to be further dilution. The idea that they can head off cryptocurrencies of the past by this mechanism is just complete nonsense. So it's a fascinating situation. People are going to write histories about this, rather like they did about the South Sea bubble, the Mississippi bubble, the tulip mania, and all the rest of them.
So, obviously we've seen both gold and silver break out to the upside of many of their moving averages recently. So what does the commitment of traders report have to do with the rally, Alasdair? Are there increases due to momentum, or are they driven by the COT reports?
Well, I don't think that the position is being driven by the COT reports, but we keep an eye on it because really what we want to see is the amount of bullishness that might be already in the particular metal. And I was looking at the situation on gold earlier today because the report was delayed actually until yesterday. And when you look at the managed money category, which basically are the hedge funds, these are algorithmic traders and, all the rest of it, they have actually increased their position very, very sharply, which is hardly surprising because open interest since the beginning of this month has increased by over 100,000 contracts. I mean, that's a very, very big jump. So you would say on that basis that the market has suddenly become really quite overbought. Now, I mean, if we were dealing with a stock in the stock market, we would say that, it's time it had a little bit of consolidation back. We need to get it back into firmer hands before the next move can occur. But in the case of gold and silver, that's very often the right thing to do, but it's now becoming very much an event-driven situation because I find that people are beginning to wake up to this inflation threat. And then there is the next problem. The next problem will be, what are the Fed going to do when tapering begins to undermine financial assets? Bond yields start rising and equity prices start falling. I mean, from the Fed's point of view, that's not an outcome they want to see. So they will probably stop tapering quite smartly or adjust it. I think that's a good phrase, isn't it? They'll adjust their tapering. And if the stock market falls quite heavily, which I think is a very strong possibility, then the only way they can stop it is to bring back quantitative easing. And instead of doing, 125 a month or whatever, if they they'd probably have to jack it up to over 200 billion a month, to try and stabilize the market. Now, that then destroys the dollar. But then you've got foreigners holding dollars already, and about 14 trillion, I think, at the last count of that, was invested in equities. Equities start tanking. If the Fed doesn't do anything about it, the foreigners are going to sell anyway. So, I think they've got to the point where they're damned if they do and they're damned if they don't. And that, I think, is going to be the next real problem that we're all going to face. And I think there's a general sense of unease developing, which I think is beginning to be reflected in the gold price. And I don't see the rise in the gold price stopping here necessarily. I think it's too early to say that people are viewing it as not so much the gold price rising, but the purchasing power of the dollar falling. But it's not going to take an awful lot for people to begin to think that way.
Mm-hmm. So you recently wrote an article as well about the golden cross in the 10-year Treasury yield. Could this be contributing to gold's momentum as well?
I think for technical traders, probably yes. The reason for pointing that out is that a golden cross is a very reliable indicator of a change in underlying trend. And in this case, the trend is of the yield on this 10-year US Treasury bond. What that is telling us is that the yield is going to go quite a lot higher. But if you marry that with what we've seen in terms of monetary inflation, I mean, it really should be no surprise. So the people who would pay attention to a golden cross aren't necessarily following the underlying developments, which are far more serious than a technical development that might support a rise in the yield to around about 3%, which is roughly what it's telling us at the moment. Mm. It's a lot more serious than that. And we're going to see yields on US debt far higher than that, I think, particularly at the short end. There may be some leveling out as you go longer and longer, because what tends to happen is that there is always an appetite amongst the pension funds and the insurance companies for long-term, high-yielding, nominal yielding government debt. So there will be some support at the long end. But what I do see is that interest rates at the short end, they will rise against the desire of the Fed. The Fed will have no option but to follow it. It won't be led by the Fed at all.
So you and I have spoken before about the Basel III regulations, some of which are going to be coming into effect first thing in the new year. So what kind of market reaction could we see as a part of that looming deadline? Or has the market already priced that in?
Well, I think the first thing to say is that the point about the Basel III net stable funding ratio regulations, which is what you're referring to, is that it doesn't necessarily force a bullion bank to run a balanced book or to remove itself from derivatives dealing entirely. It places some fairly strict conditions on how they will operate unless they're prepared to accept a balance sheet penalty. By balance sheet penalty, what I mean is the cost of funding it out of your liabilities is increased compared with, say, holding other assets. And the idea behind this was really following the great financial crisis, the failure of Lehman. The G20 got together and instructed the Bank of International Settlements with its Basel Committee to come up with new regulations so that it would never happen again. And one of the big issues, obviously, was derivatives. Now, the forward market in London, the LBMA seemed keen to insist that it's not derivatives because something like 60% of trades settled, physically. They're not actually settled physically, but they cross out. But anyway, and of course, you've also got regulated derivatives like futures. It's going to be more expensive for people to run positions in those in gold and silver derivatives and derivatives and other commodities, incidentally. So it doesn't necessarily stop it. America has already introduced the requirement to comply with these regulations, the net stable funding ratio. Europe has also done the same. The UK is going to do this from the first day of trading next year. So we're the laggards in this. I mean, I talk to other people like in Australia, and they've already done it out there, and so on and so forth. It's a slightly messy scene because a European regulator will look at, say, for example, UBS, because the Swiss are in with the European regulator on this one, and see what their position is in London. So even though London hasn't gone with it yet, as far as the European regulator is concerned, they're already applying these new rules to banks like UBS or Deutsche Bank or whoever. So it is a slightly complex situation. It is not black and white, quite in the sense that everybody's got to just give up running books, if you like, unbalanced books in the market. But what we can expect is that over time, the liquidity in that market will diminish from banking sources. There is a far bigger problem, and that is it's hyperinflation, as we were talking earlier. Sooner or later, and it's probably sooner rather than later, bullion banks with short positions, and that community is always net short, incidentally, are going to be running scared and wanting to close down those short positions simply because with all the big central banks printing money and trying to suppress interest rates, the gold price and the silver price are going to run away from them. So, and they don't want to be caught out like that. So there's a lot of tension in the market at the moment. And I think that it's only a matter of time, short period of time, before prices do go significantly higher because of the fundamental background, the loss of purchasing power for fiat currencies. And those banks are going to want to close down their positions as much as possible. I think the real problem they have is probably on COMEX, because they need to dispose of a futures position in order to square their books. Whereas in London on the LBMA, their short position is basically to customers, if you like, depositors with gold-linked accounts. And I think they just turn around and say, we're removing the gold link in your deposit account. We perfectly understand if you want to take your deposit elsewhere. So in that sense, London is quite easy to deal with. A lot of people would be terribly upset. But we have seen the Dutch banks in the past have done this. ABN AMRO and I think Rabobank have done this in the past. I think in 2011, they no longer were prepared to deliver gold on a customer's request against an unallocated account. So that's a milder version of what we're talking about. But I think the real problem is going to be on COMEX in this one.
So, of course, Alasdair, a lot of these conversations that we have are very US centric, but how does the ECB and their monetary policies fit into this as well?
Well, I mean, basically, they are as inflationists as anyone else. I mean, the structure of the bank and the structure of the European banking system is somewhat different from the US. But it's far more statist. The whole objective of the ECB is to ensure governments are financed. That's how it has become. I mean, originally their mandate was to, ensure a stable, growing economy, if you like, within the Eurozone. That, I have to say, is not what they have been doing at all. They have just been, the whole point about having a deposit rate of -0.5% is it means that banks can expand their credit by borrowing from the ECB at 0.5% and lending it, say, to the Spanish or the Italian government at 0.5%. This is just crazy. These are spendthrift governments. You look at the Italian government, for goodness sake. That's now run by a former chairman of the ECB, Mario Draghi. Look at Greece. Exactly the same problem there. Spain, Portugal, anyone you like, they are basically bust. France is also basically bust on any, insolvent on any analysis. Nobody should be lending money to them. The ECB is there to basically guarantee these governments will get the money. And it is inflationary. It works against the private sector. It means the ability of the private sector to deliver progress, growth, tax revenue for their governments and all the rest of it becomes increasingly hampered, which just makes the situation worse for the governments concerned. France is already, if you take the nationalized industries as well as central government, you're looking at 65% of GDP is government, and much of the rest is all just government contracts and controlled and so on. Italy is, notionally it's 50%, but I reckon it's quite a bit more than that. These are failing countries. They really are. So I hope that answers your question. Oh, another point worth making is that because of all the lending to governments, buying government bonds and all the rest of it, the commercial banks have become horribly overgeared. They really have. If you just look at, for example, the ratio between total liabilities and equity, you're looking at numbers like 30 times. It's a
mind-blowing number.
It's a mind-blowing number. Now, on top of that, of course, if you look at the share prices of many of these banks, they're trading at enormous discounts to book value. I haven't looked at it recently, but not so long ago, Crédit Agricole was the big French bank, was trading at an 80% discount, nearly an 80% discount to book value, like it was 20% of book value. And which meant that as far as a shareholder is concerned, the gearing, if you take it through into assets, was something like 70 times. You think, oh my God, is this a system that's going to survive? one way in which they've managed to continue with this broken system is that local regulators, and this is particularly noticeable in Italy, huge level of non-performing loans in Italy. So what the local regulator does is the local regulator turns around and says, no. We're going to call them performing loans. What then happens is that the Banca de Montepesci or whoever, whichever bank, what they can then do is they can take those performing loans, performing inverted commas, and offer them to the Banca d'Italia, the central bank, the national central bank, as collateral against a loan. So what now happens is that the Banca d'Italia, it is short of euros. In other words, it's euros have come off its balance sheet. It's short in the system, and it's all this debt, all this non-performing loans has just been pushed into the system. And it's this that's behind the imbalances, or most of the imbalances within the Target 2 system. And this is why the Bundesbank is owed something like 1.2 trillion euros. They'll never recover it. And at some stage, the whole system, I think, will probably implode.
Like you say, the system seems very fragile, and it doesn't seem like they would be able to withstand any sort of speed bump.
Yeah. And you got, for goodness sake, you got Christine Lagarde, who is a lawyer. She was indicted in France for some sort of fraud. I can't remember. But anyway, putting that aside, she is now head of the ECB, hasn't got a clue about economics. I think she's probably described as a safe pair of hands. But, and then what does she do? She says, we're going to lend money for green, issues. Green issues and all the rest of it. They got a death wish.
So, Alasdair, seemingly on the other side of this coin, we see countries like China and Russia, building their gold reserves. So, could they have a dramatic effect on the metals just in terms of sentiment from that strategy? I don't really see sentiment entering into it in a sense, because they're not disclosing what they've got, and we run on a world of statistics now. So. Nobody has any gumption. Nobody actually sits there and thinks, it's quite likely that they have the following. That's not enough for a decision. You actually want to see the lies before you act on a government lie. So, they're not disclosing the situation. They may disclose it at some stage, but I think in terms of the effect on the West, that is almost like placing a nuclear bomb under the Western financial system. Mm-hmm. Which tells me that they won't do it, because nobody wants to get involved in a nuclear conflict, whether it's a monetary equivalent or the real thing. Mm-hmm. Apart from anything else, China has a lot of dollars. I don't know whether she's hedged them at all. I've been told by one economist, or it's been reported, an economist apparently stood up and reported that China has hedged most of her dollar currency. So I don't know whether that's right. It was quite a respectable economist, but I can't verify it, so I'm not going to say who it was. But it's, so we just don't know, I think, Tom. We just don't know really what the situation is. All I can tell you is that China introduced regulations back in 1983, appointing the People's Bank of China with the sole responsibility for managing the nation's gold and silver reserves. It was running capital surpluses, but you had a mixture of dollars and euros coming in, or it was pre-euros actually, Deutschmarks and so on, coming into the country, which, again, nobody in the country was allowed to hold foreign exchange. So this was inward investment coming in. That money was taken, and some of it, I'm convinced, was applied to the purchase of gold in that big bear market. When the factories that had been invested in started bearing fruit and exports from China started increasing,
Likewise, there were substantial inflows of capital. And this was really from exports coming in. And there was also the continuing flows of capital coming in to build factories and so on and so forth. So the People's Bank had an awful lot of dollars in the main to deal with. And some of it, as we know, went into US Treasuries, but an awful lot of it would have gone into gold. And I've estimated in the past, I mean, the other thing that confirms this is that from 1983 to 2002, the citizens in China were not allowed to own gold or silver. And then suddenly there's a change of policy. They set up the Shanghai Gold Exchange. People were allowed to buy gold. And furthermore, the state advertised on television, run out and buy gold and silver. They actually advertised it. Now, that tells me that at that point, the state felt that it had accumulated enough gold, particularly gold, for its monetary purposes, even though it hadn't declared it. It then allowed its own nationals to have a go. And so far, the estimates appear to be that something like 17,000 tons have been accumulated by the nationals, on top of what I would estimate now to be 25 and 30,000 tons acquired by the state. Mm-hmm. Russia, I mean, when I talk to sort of people who are in the know, we're talking mixture of sort of finance and sort of quasi-intelligence sources. The suggestion appears to be they've probably got about 10,000 tons, some of which is obviously declared and on the Bank of Russia's balance sheet. So they are prepared for a collapse of Western fiat currencies. Of that, I have no doubt whatsoever.
Mm-hmm. So if let's say China were to introduce a gold-backed currency of some sort, Alasdair, what consequences would that have for the US dollar? Wouldn't they have to have it be more attractive to use for other countries to trade in to actually hurt the dollar dramatically?
It's a very complex question. I mean, the first thing that they would have to do in accepting or putting some gold backing into the yuan or the ruble is accepting that their currency will rise in value substantially over time against the dollar. So they will be reluctant to do that. And they'll be reluctant to do it for two reasons. I think the first reason is that they've got their eye on current trade and current trading relationships. And I think the second reason is that to a degree, the Marxist economists have accepted the Keynesian paradigm, as it were. So, they would think in terms of a competitive currency rather than the damage that a loss of purchasing power of the currency might do to the domestic, if you like, economy. So it is a complex issue. And I've always, therefore, taken the view that their acquisition of gold, potentially to back their currencies, is a fallback position. It is not something that they will, sort of immediately come out with at some stage to secure the position. But what you do see, which is interesting, is China in particular has moved very strongly to remove any speculation from within the economy. I mean, for example, the collapse of Evergrande was a consequence of that. I mean, people don't, they just think it was sort of, it was like a bubble going wrong. But it was actually a deliberate act of policy from central government to take the speculation out of the system. They've jumped down on shadow banking big time. And so you can see that they have been determined not to expose the country to the possibility of a shock from speculative unwinding. And they learned this lesson a long time ago, and they're not going to repeat it. I have to say that our Western nations are not in that position at all. We are very much exposed to a speculative shock. The Chinese in particular have taken great care to ensure that they are not vulnerable to that situation.
Excellent, Alasdair. I think that's a good place to wrap up. We've covered a lot of ground here today. Is there anything you want to add before we wrap up here?
Yeah. I'm writing an article which will be published on Thursday, which basically updates an essay by Ludwig von Mises, which was added as an addendum to his original theory of money and credit. He wrote this in 1952 about how we might return to sound money. Now, the situation has changed hugely since 1952 in a number of ways. So I've tried to update that. And I hope that if he was alive today, he would he would agree with much of it. But I think that might be quite interesting because the evidence that I produce about why you are on a hyperinflation course, unless that is changed, I think is very, very compelling. And I think, even if you don't believe or understand that sound money is actually physical gold, with the addition of physical silver, if you don't believe that, then you should still have a look at the beginning of this article to understand the dangers that we all face. Because the dollar goes, we all go. I mean, we're all tied to the dollar. It's as simple as that. So this is a very important issue. Anyway, I've tried to update the means by which we can get back to sound money. And I'm quite hopeful that we'll do it, but we'll probably do it with the dollar's purchasing power reduced very substantially from where we are. I mean, and this could happen quite quickly too. It's not something I would hang around and sort of say, well, you've got plenty of time to go out and buy your gold and silver. I think that you've either got it or you haven't. It's getting to that stage now. So anyway, that'll be on Goldmoney's website. So you go Goldmoney, hit research, and look for insights. And you might want to open an account with us at the same time.
Perfect. We'll try to repost that on our Twitter and our website as well, Alasdair. Of course, your Twitter is @Macleod Finance. Alasdair, thanks so much for your time today. Really appreciate it.
That's very much my pleasure, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.